All right, let's bring in Halima Didero now. She's a senior associate financial derivatives company. Great to have you, Halima. So yeah, we did get that final rate setting meeting of 2025 in the U.S. It's the third time this year the cutting rates. How do you see proceedings yesterday and what the Fed chair had to say?
Okay, so the decision was the third for the old year, the year 2025, and the last one. And it goes in line with what the market expected even before the decision. And so the main reason for this shift is because the Fed made it known that there is weakness in the job market, and they're trying to at least help the job market to grow, and because of uncertainties too in the economy, meaning there is a trade-off. The Fed is trying to trade off price stability, which is one of its mandates, for economic growth. And so we'll see so many differences and changes in different parts of the economy, even down to Nigeria. But let's first go to investment. We might see investors reshuffling their portfolios to equity markets rather than bond market, because equity market thrives in lower interest rates regime. But because there's an expectation of a more tightening in the coming year, we might not see much rally as expected in the stock market. And if we move down to commodities markets, we'll say that demand will increase because there will be more fund for businesses to operate. And so oil price might see an increase in the coming weeks and in the coming months. And let's come to Nigeria and Africa. What does it mean for us going forward? It means we might see increase in hot money like FPI. That is, investors might shift to Nigeria and some other countries that has higher interest rates to take advantage or take position of such. And apart from that, we might see that borrowings, either for government or for businesses, might see an ease in terms of refunding, that is, ease in global financial costs, which will translate to better financing conditions, both for government and businesses. And so moving forward, we'll see that the overall thing that would affect what the direction will look like for the Fed will be the employment data, inflation, and even the general market response to all of this.
So we see Fed Chair Jerome Powell there. He indicated that the bar for additional rate cuts may now be higher. What do you think this means for markets? Is he really that? I think they're more sensitive about the job market at this point. How are you seeing that?
Yeah. So as I said earlier, that means they are trying to signal to the market that going forward in 2026, there might be more tightening in as regards interest rate decision. So there will be like a status quo more than interest rate cuts. And that means inflation will have been sustained and moving towards the 2% target rate that was initially set. And that will mean that labor market too will be cooling and not crashing. And also it will mean that financial conditions will warrant the easing before the Fed could move to ease the interest rates. And more than we have now, that means the stock markets might crash. The bond market or the yield in the U.S. Treasury bonds might increase, and we're likely to see volatility as regards the direction and the reaction for the market. So the markets will respond more to employment rates, inflation rates, much more than expectation of what the Fed is likely to do. So, and commodities like gold and oil could become more higher in terms of the price, because the dollar too will become higher, given that high interest rates helps the dollar to appreciate. So those are the things we are likely to see.
All right, and this time, I guess as expected, the dissenting votes. Definitely, we did get Stephen Myron. He did want about 0.5% cut. Two other members, I think they voted for a hold. So I guess we still have that division right there. What does this suggest about internal views on monetary policy? Seeing the members are so divided at this point.
So for the divergence in the views of the committee member, it's not a big deal. It's expected because individuals in the committee have different perspective when it comes to the job data, inflation rates, and which of the mandates is much more pressing or important to work towards. And so that's why we are seeing different views as regards what the interest rate decisions should be and what the direction should be going forward. And so that means some part of the committee are more tending towards job growth, while some are tending towards stability of the price pressure in the US as a whole. So it's not a bad thing. It's just trying to tell us that there is no uniformity in terms of direction, which is not so good. But on the flip side, it's trying to tell us that the committee members are looking at the data in the economy differently and with different views and different objectives.
All right, let's bring it back here now for the oil and gas market. We're seeing PMS pump prices. According to your data, that's declined by 2.74% to 885 naira per litre from 910 per litre. Talk to me about what's playing out there in the market.
Okay, so the price dropped from 910 per litre to 885 per litre. And we should not forget that we already said because the market is deregulated, the domestic price for PMS will now be in tandem or will be reflecting what is happening in the global market price or direction. So that is not a surprise. And because we now have a refinery in our country and it is working effectively compared to what we used to have before. So it's a good one and it could help in tapering inflationary pressure and also reducing the queue that we usually have in the filling stations during this festive period, which could help in movement of people, goods, and ease logistics cost for companies. And so it's a good one for our inflation. It could help reduce the month-on-month inflation data that we are expecting. So it's a good one for Nigeria.
Right, and you did advise me last time to try and do some of my Christmas shopping, food shopping this week. I've not done that yet. What are you expecting next week?
Okay, so when we checked the prices for commodities in the markets, we see that most of them still stay flat, but pepper is still increasing because of seasonality effect. And we see that tomato is a bit lower in terms of price. This is because most of the farmers are now harvesting what they have on the farm because dry season is eating deeper. So in order to reduce the rate of loss, so more harvests are being done, and that's why we are seeing more supply into the market, which is crashing the price of tomato. But for onions, it's still stable, although the fresh or new onion is a bit lower than what we have here, which is 170. 170 goes for the price of old and dry onion, while the new ones and the fresh ones are a bit lower. But people prefer the old one because of the taste and all. So that's what we have now. But we are still going to see like an increase, as I said, on Tuesday. Definitely. It might not be much because of consumer resistance and maybe less disposable income, but definitely we are going to see a surge. If not a high one, it will be a moderate surge in the prices of commodities and domestic commodities.
All right, so Halima, what are you telling me now? For Christmas, if I'm trying to make, a pot of jollof rice, get some maybe fried chicken, fried turkey, hopefully some fried ram, what's that going to cost me this Christmas? What are you seeing?
It depends. It depends on your plan as regards the guests you are expecting. So the quality and the quantity will depend on the number of people you are expecting to entertain. And
Just a
so
few
that
people, maybe about 5 people, hopefully.
5 people. It depends also on what you are ready to cook or you're planning to cook to entertain your guests. So it's not a one size fit all. It depends. So,
Okay.
but just be rest assured that if you are not shopping now, you might be paying higher later in the next 1 to 2 weeks.
All right, I need to try and round up and go and do some shopping. Hopefully, thank you so much,
You're
Halima
welcome.
Adediro, for breaking it down for us.
Thanks for
Thank you.
having me.